let's take another look at this long-term picture from a slightly different perspective. This is the same series of data, although it is not a plot of nominal prices, it's a plot of inflation-adjusted stock prices, referred to as the constant dollar Dow. Now, what we have here is another measure of stock prices. It's nearly the same, but not exactly. It's a different ratio. It's stock prices not relative to dollars, but relative to the value of a basket of commodities. Let's see how this developed. Well, you had the same five-wave structure up to the 1830s, an ABC wave 2 correction right into the same price point, the same point for a 1929 high for wave 3. Wave 4 takes a slightly different corrective pattern shape. Actually took the shape of a triangle ending in 1949. We'll get into what a triangle is later today. Then wave 5 occurred right up to the upper end of the channel in 1966. But you'll notice this chart hasn't carried to a new high because stock prices relative to commodities are not where they were in 1966. In fact, I believe that one of the messages on this chart is extremely important to our outlook from today. And that occurrence has to do with this support line, which is part of the Elliott wave channel of this five-wave upward structure and starting in the late 1700s. Now, I didn't draw this line on the chart. The market did. I just made it visible by connecting the lows. Let's see what the history of the low end of stock valuation has been along this line. Back in the late 1700s, the lower end of this line supported stock prices during the Revolutionary War. Terribly bad news. Right here was the War of 1812. Stock prices held their lows right here in the Depression of this period and the Civil War. Stock prices then went up to the upper end and came down and had their very low valuation period again in 1920-21. World War I was occurring in here. The post-war inflation and deflation, and still that line held. In other words, the worst that the world could throw at that line, it still held all the way through these many, many decades. What happened after that? The great stock market crash, the Great Depression, World War II, and this line held. What happened right there? Something new and different was occurring. Something so devastating that this 200-year support line was broken as if a hot knife had gone through butter. You don't think it was Jimmy Carter, do you? Well, actually, I don't think it was Jimmy Carter, but something was going on in the late 1970s that presented the worst fundamental situation in the history of this country. If it brought stock prices down to a valuation level which was lower relative to the long-term uptrend line than any time in the previous 180 years, what could it possibly have been, and what does it mean? Well, I think it has a lot to do with the market discounting some very bad events in the area of the global debt situation. The inflation of the 1970s was not only bad because it was an inflationary period, but because it was debt-based and continues to be so. And as we enter deflation, that is going to be a huge problem for not only the debtors, but the creditors, and that includes individuals, corporations, and governments around the world. Regardless of whether you believe that's a reason, we do have the evidence that something changed, something for the negative. Now, what was interesting was back in 1982, when this market made its low, it was calling for an advance, just like the nominal dollar chart that we've been looking at. The nominal dollar chart said we need a fifth wave to new all-time highs. This chart said, hey, we've done A down of an ABC correction. We need some kind of solid upward movement for wave B. What does it call for now? Well, currently, Our stock price chart says we need a bear market. We've probably completed 5 waves up at least back to 1932 and maybe longer. We need a major decline. What is this chart saying? It's also saying we need a major decline because we haven't finished the bear market pattern, the wave C pattern. Someone said, and it's a reasonable question, the previous 4th wave on the constant dollar chart isn't that much lower than wave A. If wave C comes down, it should bottom somewhere in this range of the triangle, which is the lowest point being the 1932 low, and of course the apex being 1949. There is easily a way that the nominal Dow Jones Industrial Average can fall from somewhere near 3,000 down to below or down near 300 or lower, and have the constant dollar chart fall only to this area. And that is if we go into a severe across-the-board deflation so that the prices of commodities are falling almost as fast as the prices of stocks. Because that's what this chart is. It's a ratio of stock values to commodity values. So this chart I fully expect to show declining prices at a much slower rate because commodities should be falling also. The last time this happened was 1929 to 1933. Now I think a reasonable question might be, where is the next or the current major bear market likely to bottom? You may have noticed that I haven't been doing a whole lot of television lately. That's because I don't want to answer this question. If we've had 5 waves up from the late 1700s right into a high here in the 1980s, how much risk does this market hold? You already know what the likelihood is, what the probability is. Where should the correction eventually find its lowest price point? The answer is somewhere in the area of the 4th wave of the preceding 5-wave movement of the same degree. And of course that is in this range. The low is 41 and the high is about 380. That's a long way down. Now, I'm not here to predict that the market is going to do this, but I am here to point out that Elliott observed that when a 5-wave sequence of any size and duration ended according to his rules and guidelines, as long as all were followed faithfully, that the place that the ensuing bear market usually found its low was somewhere in that area. That's all we can say. However, that is a likelihood that, in my opinion, is so great that it is at least worth preparing for in terms of making sure you are not leveraged in the other direction. Okay, let's take a look at another market. We've been looking at stocks so far this morning. I'd like to take a look at a chart of gold. We're not looking at gold only because it's a different market, but because it's a commodity. And commodities have one difference in their normal wave development from that of the stock market. First, let's walk through the 5-wave structure, and I'll get to the difference as we approach the end of it. Back here in the late 1960s, of course, the price of gold was fixed. Nevertheless, it had an initial run-up to about $42 an ounce, came back in 1970 to match the previous low in a wave 1 and 2. Pessimism should match, of course, this period in terms of the ability of the price of gold to go up. And sure enough, in 1970, at least 2 economists were quoted widely as saying, as soon as the price controls on gold are removed, it's not going to go up, it's going to go down to $6 an ounce. Why? Because gold has no industrial value. And of course, it's an anachronism as far as money goes. Well, that set the stage for a good 3rd wave, and gold exploded right into this peak in 1974. In March of 1974, it hit $180 an ounce. exceeding even the wildest expectations of the gold bugs who got on the bandwagon early and said, you want to own gold, it's going to go up. Then came wave 4. Notice the alternation. This is a sharp movement against the trend. Wave 4 is different. It took that sideways shape, which included a new high. This new high, by the way, occurred on the last day of the year of 1974, when gold was legalized in terms of ownership by Americans. A classic case of people buying in anticipation of further buying and marking the exact top by doing so. Gold then collapsed 50%. That was a surprising disappointment to the gold bugs, particularly following the legalization of gold in the United States. In fact, one prominent gold bug committed suicide right about here, so I would assume that he was quite disappointed at the time. Actually, it was very unfortunate. He was a terrific analyst, and I wish he were around today. Straighten me out on some markets. In any case, once wave 4 was over, the 5th wave began, and this, as is typical with commodities, was the longest and strongest impulse wave in the sequence. That's the difference between commodities and stocks on the major trend when the major trend is up. Let me clarify that. The 5-wave structure, the tendencies in the 5-wave structure in terms of wave 3 generally being longer holds true even in commodities on the smaller degree trends and even on major trends in parts of corrections which are heading downward. But when the trend is up and it's a major trending market, usually it is the 5th wave which puts on the best performance. Well, is there a reason for this? After all, what we're studying here is social psychology, mass psychology. And I think the answer is yes. You see, when the stock market is creating its 5th wave, it's moving up on an emotion called hope. People are hoping things will get better, and they're willing to put more money into that market and say, around the corner things are going to be better, prices will be higher, I'm going to take a shot at this. Hope takes a while to develop and a while to dissipate. That's why 5th waves tend not to be as powerful as the 3rd wave in the stock market, and it is also why tops often take a bit of time, if not clearly obvious on the price chart, at least obvious in terms of the technical development of the advances and declines and so forth. Commodities are different. The 5th wave in a commodity is not propelled by hope, it's propelled by a different emotion called fear. When gold is roaring upward in this 5th wave, it's not because people are hoping the future is going to be better. Of course, there are a few guys out there hoping it'll be worse, but for the most part, it is being bought by people who are fearful. They're afraid of inflation. They're afraid of what the government's going to do in reaction to it. They're afraid of the financial situation in general, and they're buying gold to protect themselves. When wheat is moving up very powerfully in a 5th wave, it is not because of hope about the future. It's because of fear. Fear of crop failure, fear of drought, you name it. That's why commodities generally have a strong 5th wave. Now, let's examine this chart to help decide where the bear market, which started in January of 1980, is likely to bottom. Notice I say likely. It's not guaranteed, but until proved otherwise by a clear 5-wave structure to the upside indicating an impulse wave, I say it's best to withhold buying until the ultimate downside target area by the 4th wave guideline is reached. Well, the span of the previous 4th wave in this 5-wave sequence is here, between $197.50 an ounce and $103.50 an ounce. That's a long way down, but that is where the wave principle suggests that the ultimate bear market low in gold will occur, somewhere in that range. And if the guideline is to be taken as it usually develops, probably nearer the lower end than the upper end. Well, this bear market, in my opinion, is still developing. The real deflationary period, as suggested by declining stock prices and declining gold prices, if we're right on these two charts, lies ahead. It is quite possible because bear market patterns or corrective patterns often have very strong rallies within them, that gold could see higher prices on a short